Welcome, everyone, and thank you for bearing with us for a few minutes here as we're getting started a little bit late. But welcome to day 4 of our virtual International Council this week. We are focusing this week on rebuilding the global economy and strengthening the multilateral system. We'll be focused today on some of the emerging market debt and financial stability risks. And I'm just thrilled to have a fantastic lineup of speakers with us today, and taking a virtual trip around the world, so to speak, the only travel that I'm doing during the pandemic. And I'm also very pleased to share that our panelists today are all members of our new Global Advisory Council. So we're just delighted to have you on board and appreciate your expertise here at the committee. So before I turn it over to them, I just want to go through a few quick housekeeping notes. We'll reserve some time at the end for audience questions. If you have a question, please enter it into the questions pane of the webinar toolbar. We'll collect these throughout and we'll call on individuals at the end. We will unmute your microphone to do that so you can pose your questions directly to the speakers. So please make sure that your microphone is green when it comes time for the Q&A. Finally, I want to thank our sponsors. Morgan Stanley is sponsoring today's event, and they've been a long-standing supporter of the Bretton Woods Committee, as well as SICPA Holdings. So we appreciate their generosity and support of our programs. Let me now quickly introduce Bill before he turns it over to our speakers. As many of you know, Bill is a member of our executive committee where he's been leading this exciting organizational renewal. He's also currently the president and CEO of William R. Rhodes Global Advisors and former chairman and CEO of Citibank. So Bill, thank you very much for leading this conversation, and I'll turn it over to you.
Okay, thank you very much, Emily. For all of you who are on the phone participating, webinar, whatever, Emily is the rock of this organization and has been a tremendous help in putting us back together again. And as she said, all of the members on this panel are involved deeply in the renewal of Bretton Woods on our advisory committee. And I thank you all for participating. I think we are very fortunate to have such a first-rate panel to discuss our topic, which is emerging market debt and financial stability, which I believe is one of the key issues facing the world today. Particularly given the 100-year COVID-19 pandemic event, I believe this is the greatest health and economic challenge the world has faced in the last 100 years, along with the tremendous fallout financially it brings, something we have not seen since the Great Depression. Yesterday at our Bretton Woods sessions, we had interviews with the managing director of the International Monetary Fund, Kristalina Georgieva, and the president of the World Bank, David Malpass. They both agreed that this is the greatest challenge that either institution has faced since their foundation at Bretton Woods in 1944. The G20 had extended a debt moratorium to the poorest nations until the end of this year, and yesterday they agreed to extend it for another 6 months. Many people, including David Malpass, feel it should have been extended for a full year. Two of the major challenges raised by our speakers yesterday were the role of the private sector in restructuring the debt of poorer nations, along with the debt of some of the more advanced emerging market economies, which were in trouble even before COVID hit. Also, the role of China is obviously key here, because the last time we had a major financial crisis, China wasn't a major creditor nation. And today, 10 years later, China is one of the largest creditor nations, particularly with their initiative of One Belt, One Road lending program, which they view as sort of an Asian model of the Marshall Plan. The Kiel Institute estimates that China's outstanding loans to mostly emerging market countries exceed 520 billion US dollars. And this has raised questions of transparency on China's part because it is not a full member of the Paris Club and has only agreed to observer status there. Most of the external debt that China has extended has been done so by the China Development Bank and the China Exim. As I said, we are very fortunate to have a first-rate panel here And I will run through who we have. First, Maria Ramos, a former chief executive of the Absa Group, and now co-chair of the UN General Assembly Group of the Task Force on Digital Financing. Arminio Fraga, founder of Gávea, Investimentos, and former governor of the Central Bank of Brazil. And Christianson, CEO of Morgan Stanley China and co-CEO of Morgan Stanley Asia Pacific. And I'd like to thank Wei in particular because Morgan Stanley is financing the session. I've had the pleasure of working with all of you over the years, and I can't think of a better group to be working with. I was given a series of questions to ask you, and the first one is our introductory question, which is, in many emerging market economies, the coronavirus pandemic has triggered a drop in commodity prices, a contraction in export volumes, loss of remittances, and significant capital outflows. How has the pandemic influenced the debt outlook in these countries, and how might debt distress in emerging market countries impact the global economy and the financial system? Maria, I think you're back on. So I'm always being told by my friends from Africa, we always leave Africa last. We always take Asia, and Latin America first. So I'm giving you the opening shot on this one. So you can't accuse me of not taking a particular interest in Africa. So I'd ask you to give your thoughts on that subject.
Well, thank you very much, Bill, and good day, everyone. It's a pleasure to be here and to be sharing the floor with such a distinguished panel of friends and colleagues. So thanks very much for the opportunity this afternoon. And I think you've asked me a very big and profound question, and it's a daunting task to try and answer it, particularly where it relates to Africa. It's, as you know, you and I go back a long way, and as you know, it's a continent, a big continent of 55 countries, and COVID's impacted the continent in a devastating manner, both in terms of human lives, but also in terms of an unprecedented economic crisis. And so in trying to answer the question around its impact on economic recovery and debt sustainability, I thought I'll try and just make a few opening points. And then I'm hoping, and I know we will come back to a lot of these issues. You mentioned the fact that the issues around this crisis that's been occasioned by COVID-19 are profound, and indeed they are. The economic cost is deep, the economic impact has been deep, and the impact on human lives, as I said a minute ago, is huge. Millions of jobs and livelihoods have been lost. And in Africa, informal workers' wages, for example, are expected to decline by over 80%, which exacerbates the income inequality and poverty that already exists. And you mentioned the IMF MD, Kristalina Georgieva, just a second ago, and she spoke last week at the LSE, and she talked about the fact that some $12 trillion of fiscal support has been provided to households and firms, together with unprecedented monetary policy actions, which have ensured that the credit markets continue to operate and that there's sufficient liquidity for them to function. But of course, the reality is that only a fraction of that is in sub-Saharan Africa. So the impact on sub-Saharan Africa, and if you looked at the economic outlook and projections of growth for the year, which the IMF published just 2 days ago. GDP in Africa is expected to be negative 3% for the year, and it will rebound marginally to 3.1% for 2021, and every single aspect of economic life across this continent has been impacted. We also know from the work that's been done and published by the World Bank that some 100 million people across the world are being plunged into extreme poverty. Somewhere between 26 million to 40 million of those on the African continent, and female poverty is disproportionately high in this region. So that's by way of backdrop. Global trade is also expected to be severely impacted, with contracted by around 10-11% in 2020, and by the World Bank's estimates, output losses for the sub-Saharan region are anywhere in the order of $37 to $79 billion. So when one takes all of that into consideration, and the fact that this will be the first time in about 25 years that Africa will actually experience a recession, one has to consider that against the backdrop of the fact that for the last 2.5 decades, really, this continent had made, and many countries in the continent, across this continent, had made some considerable progress to strengthening their economies, strengthening their institutions, particularly their monetary and fiscal institutions, but also progress around many of the measures of vulnerability and poverty alleviation. And in fact, in building financial markets, which is very important. If I just look at debt and sustainability, just to put some numbers into context, the IMF now expects Africa to reach sort of average debt to GDP of around 64.85% for 2020. And that's also against the background in which a number of countries have been able to access global capital markets in the last few years. In fact, by 2018, the new issuance had reached a high of $17 billion, and actually the average issuance had increased to around $3 billion. And you know, we have to take into consideration that over the last decade or so, Africa's creditors have also changed quite significantly. Bondholders, and as we heard just yesterday when we launched the G30 report on debt, bondholders, there's an array now of other commercial actors and hybrid participants, and importantly, China is a big player and China's policy banks. The continent's external debt has also now reached some $500 billion. And so what we have across the continent now is a different position from a debt and debt sustainability point of view than was the case, well, as you would well know, and as many people in this webinar today would know, than was the case 10, 15 years ago, 20 years ago. But it's also true to say that Africa, most countries across the African continent now have to contend with much higher borrowing costs. And even though global interest rates are low, that's not the case for African countries, which have yields which are 5 to 10% higher than most countries across the world. Debt service costs are also for many countries the highest expenditure item on their budgets. If I turn to South Africa just for a couple of minutes, South Africa, from the onset of this crisis, and the first case was reported here on the 5th of March, and from the onset of the crisis, the country took the pandemic, COVID-19, as a matter of urgent response, and an extensive and very rigorous lockdown was instituted. In fact, the economy came to a virtual standstill for 3 months, or a bit more than that. We have had a relatively large number of infections, even by continental standards. As of yesterday, there were 696,414 people that have been infected, and 18,151 deaths. There are also 626,898 recoveries. So although the death rate has, I suppose, remained comparatively low, even when we adjust for unexplained deaths, we have still had a lot of death in our country. The country did respond. The government did respond with a significant fiscal and monetary policy package, and of course that has put pressure on an already quite precarious fiscal position and debt position. We entered actually the year, even before this crisis, we were already in a very difficult economic position with high levels of unemployment, especially amongst the youth, and a fiscal position that was already facing huge risks. And the government had already announced the budget before the crisis that required significant adjustment. Of course, COVID-19 has put all of that in stark relevance and has worsened the position very considerably. And output in the second quarter contracted by 51%. The economy shed 2.2 million jobs, and that reduced the number of people employed to 14.1 million out of 39 million people of working age. So that gives you a sense of the challenges. So when we talk about debt management, it's against this background of quite a fragile economic environment that now needs to be rebuilt. And growth for the year is projected to be at a negative 6.5%. That's by the Reserve Bank standards, the South African Reserve Bank. If you looked at the numbers published by the IMF, that number is a lot worse at minus 8%, recovering to 3% next year. The budget deficit is expected to be 15.7% and debt to GDP ratios over 80%. And if the government does not do anything to restrain expenditure and to reprioritize it vigorously, it's expected that that will go to over 100% by 2023. The impact of the Moody's downgrade, Moody's was the last investment grade left for South Africa, has also been quite significant because it's taken South Africa out of the World Government Bond Index. And it's meant that some, significant reductions of foreign investors in South Africa's domestic bonds. So you would know, as would others, that South Africa's got a very well developed and very well deep and well functioning long maturity domestic capital markets, domestic bond markets, and we've always had quite a significant participation of foreign investors in the rand market for domestic bonds. That's now moved from 42.8% down to 29.9%. And I'd say that on the positive side, South Africa's debt is primarily rand debt. So the government can fund itself virtually completely in the domestic market without having to access foreign currency markets. Foreign currency debt in the entire portfolio is only 12.5%. Let me just say a few words maybe on the challenges ahead for the continent. $44 billion of debt service costs for this year or thereabouts. So I heard you mention the DSSI, which has also been talked about. It's a good move that we, if I heard you correctly, Bill, that the date has been extended by 6 months. I think that's progress. As you know, in the G30 yesterday, I think what we would like to see is that extension go out to 2022. So the longer the better, simply because this is about creating the space to resolve this crisis, and this crisis is significant. So I think the importance of that and keeping the pressure on that. I think the other issue, of course, is to make sure that we can expand eligibility, particularly for vulnerable middle-income countries. And then fundamentally important is engaging with the rating agencies to ensure that countries aren't downgraded as a consequence of applying for the DSSI. Moody's, for example, has placed 4 African countries on review for their participation in the DSSI. I have to say that the IMF and the World Bank, but the IMF in particular, has responded incredibly rapidly to the stress of many of developing countries and emerging market countries in particular as a consequence of COVID-19. And there are now $15.8 billion of funding that has been made available to 32 countries across the continent. And two final points from my side. One is that navigating the period ahead is incredibly challenging. It requires more than just a focus on debt for us in order to get the debt sustainability that we're all looking for. We actually have to find a way to create the debt sustainability. Simply creates the space for governments to shift. Governments have to find a way to shift their priorities towards health, education, and the green economy. Those parts of their economies that are going to generate jobs and create revenue opportunities. And yes, of course, they have to find and keep their eye on prudent debt management. So handing over back to you. Thanks, Paul.
Okay, thank you very much, Maria. You paint a very stark picture of Africa, but in particularly South Africa, where we work so closely together. And hopefully Cyril Ramaphosa will be able to turn that picture around with the help of you and others, because it's a country I have great affection for. So now I turn to Arminio Fraga, who is not only one of the leading financial figures in Brazil, but also helped put together the Real Plan, which took the country out of moratorium and set a baseline for where it should go, notwithstanding the problems that have happened most recently. So Arminio, please give us an update on Brazil, but also any thoughts you have on Latin America in general, and also what your thoughts are in this particular difficult period we're going through with COVID and the impact on emerging market countries.
Thank you. Thank you, Bill. Like Maria, I'm delighted to be here to be part of the advisory council of the Bretton Woods and to be here at this particular moment, although I wish we were all meeting to celebrate something. I guess it comes with the territory, it comes with life. I'll make some quick remarks on kind of the backdrop, the Bretton Woods institutions, and kind of where I see us. And then I'll give you a brief update on Brazil and the region. I will be, I'm not going to give you gory detail here. I think it would be punishing our viewers. But first, I was flipping through this morning the IMF's fiscal monitor. It's this report that often is kind of dry, but has a lot of interesting information, and it shows the stress that the planet is going through. Right? I think there's no exaggeration in saying that, particularly since the great financial crisis, we're living in the age of debt. There's just a lot of debt, government debt, and also private sector debt. There's probably a little bit less debt in the world of financial intermediation, but still plenty. So there were expectations that there'd be a lot of deleveraging after the GFC, but it didn't really happen. On the contrary, some of it is due to extremely low interest rates that have been around for much longer than anyone expected way back 12 years ago. But nonetheless, there is a lot of debt out there, and this means there's risk. Now, thinking with sort of a Bretton Woods hat, and without going back all the way 75 years, I do think also that an important feature of the world we live in is a profound lack of coordination. And it is something we need to worry about, particularly in a moment of stress like the one we're going through. Nonetheless, I think we can say, and we can pat ourselves in the back a little bit, that as far as particularly the low-income countries, the poorer countries, there is a clear attitude of supporting these painful situations full of deepening inequality and so on, as Maria put it so well. So I think the attitude is totally correct. This is an exogenous event. So Bill, you've been a banker for a long time. There's a major difference between dealing with a case of say bad luck, a bad break, or one where there is, if you're in the corporate world, bad management, and the prescriptions are totally different. So in this case, it's wonderful that the SSI is out there, and I believe more help should be on its way. This is not a sort of a business cycle phenomenon. This is not a political cycle phenomenon. And so for all good reasons, having humanitarian reasons at the top of the list, but economic reasons and so on, help is due and seems to be happening. The lack of coordination kind of spills over into the Bretton Woods institutions because arguably they could use more money. And this is a well-known situation. It's been around for a while, and now it's kind of hitting us. So that's kind of point number one. Now, the lack of coordination means that the more mature economies and the larger economies, such as China, cannot be counted on to in any way take into account pretty much what gets decided at the IMF. These are binding decisions, and therefore not much is decided that affects the mature economies. So that leaves kind of the middle income economies, so-called emerging economies. I live in one, and here I think there are some features that make this crisis different from some that we've experienced in the past. I think about Bill and I met in the early 90s. Brazil was in default. We were then going through the Brady Plan exercise, and we actually concluded that Brazil has been current on its debt since then. But the thing also, typically at that time, started out with some kind of balance of payments crisis. And now I think a salient feature of the emerging markets is the almost total absence of fixed exchange rates or managed exchange rates. Most countries have flexible exchange rates. And this means there's less pressure for balance of payments financing, and the issues tend to be more domestic. They're not totally that way, because with open capital accounts, domestic problems tend to spill over into the capital account, and maybe countries at some point, even though they're dealing with domestic debt, often primarily held by domestic investors, that's the case in Brazil, there still could be balance of payments pressure. The exchange rate in Brazil is a very clear sign of that. But the issues are different. Many of the more mature emerging markets have fairly deep domestic debt markets, and they've been using this, say, policy space, in some cases very aggressively. This has been the case in Brazil. The fiscal expansion has been gigantic, I should say. And Brazil has gone from what was a forecast of a GDP drop that would get close to double digits to a forecast now. The IMF has 5.8. Local forecasts tend to be closer to 5, and it is in good part driven by this extraordinary fiscal expansion. On the global scene, you see, and this is in the fiscal monitor, I highly recommend flipping through it. Most people just look at the wheel, but I think the fiscal monitor has a lot of very important data, well displayed in it. One thing you see that is, to me, worrisome is, and you see it beyond Brazil. I was worried at first that this was a mostly Brazilian phenomenon, but that is the shortening of maturities in the debt. Now, this typically happens under pressure, and it's a natural thing to do. You have steep yield curves, well, it's a sort of call it a tropical QE type of feature, where treasuries sell less, they sell less long-term debt, more short-term debt, which is in effect exactly what QE does. And this is fine up to a certain point. It buys time, but it increases risk. So in the case of Brazil, you have a lot more debt, approaching 100% of GDP, which ever shorter maturities and duration. The government's also placing a lot of floaters. So Brazil is dealing with this as an internal challenge. I think it is important when one thinks of Brazil to realize that this is not the first, but the second massive recession that we're going through in a very short period of time. We had a collapse starting in 2014, lasted 2.5 years, but took us down 7.5% GDP. So it's more than the current drop in GDP. That's the Brazil story. Mexico's drop will be even greater. I'll get to that in a second. But let me wrap up on the Brazil situation. So Brazil has now to deal with very important challenges. Growth has been very modest over the last 40 years, which is very frustrating for us. Same is the case in Mexico. So we have a lot of work to do, a lot of thinking to do, and it really is a deep question that if you squeeze it down to the limit, begs the almost a philosophical political issue. How come we cannot organize our lives to grow faster? We should be growing faster, just imitating what works all over the world, investing a little bit more, educating more, and somehow do it, but very modestly. That's the Brazil story. The need for fiscal adjustment is now obvious and urgent, but at the same time, the need to deal with the pandemic is still there. And the internal political pressures seem to be growing. Brazil is moving towards kind of old-fashioned politics, which was not what had originally been sort of advertised. And so I think we got some work to do, and it might be a bumpy ride, sadly. Now, moving beyond Brazil to finish, I think is no exaggeration to say, you know, Latin America is pretty much a disaster zone. Uruguay is doing well. Chile is doing poorly by Chilean standards, but I think they've done well enough over enough time to be able to do it. I hope Colombia the same. But for the most part, you look at the region. Venezuela is total failed state disaster zone. Argentina defaulted again, still dealing with high inflation. Very complicated case. Brazil, I just mentioned. Mexico has opted to do much less on the fiscal front and will live with a greater decline in growth. The question is, will they, in the medium term, benefit from not having run their public finances very badly? I think this is probably a political strategy. You see it in other parts of the world where governments feel perhaps they can't quite rely on so much foreign support. They tend to be more cautious. I think Russia is a good example of that. But it is, in the end, a real challenge. If you look back, Maria knows this better than anyone, but if you look back the last 15 years, I didn't look up the numbers, but sub-Saharan Africa has grown from a much lower base, but has grown a lot faster than LATAM. So you know, we have some work to do. That's kind of my summary. I'd be happy to go deeper on the Brazilian case if you want. But anyway, in a nutshell, I think the low-income countries deserve a lot of help. In their case, it clearly connects to the balance of payments needs, importing health things and so on. Whereas the middle-income countries, I believe, are unless they go really deep into crisis, which some have and others may, are dealing more with a domestic issue than an international one. And in the meantime, the big players in the world don't seem to get along, and usually that's also something to worry about. Thank you.
Thank you very much, Arminio. I think you covered the waterfront, so to speak, both in the sense of the international challenges we're facing with this COVID crisis and some of the differences from what we've seen in the past. You obviously ran through Latin America, and I agree very much with you that Latin America, when you compare it to other areas of the world, particularly emerging Asia, is in a very difficult situation. And of course, Brazil, people tend to forget, had just come out of a major recession. And Argentina went into this just like Ecuador with major problems. Argentina, its 9th default in its history. So for Latin America, there are a lot of challenges. Wei, we now come to you because, you know, China is the bright spot. The only country in the G20 that appears to have any growth going for it. And for the full year, talking to my friends at the People's Bank of China, they estimate that China will have growth of 2% for the full year. The only member of the G20 which will have growth. And of course, people are very concerned about you know, where China is going on trade, what the situation is vis-a-vis the One Belt, One Road, and you know, I mentioned the whole situation with the Paris Club. So I turn it over to you, who I always have viewed as the most experienced investment banker, not only in China, but probably in all of Asia. So you have the floor, and thank you.
Well, thank you, Bill, for the kind introduction. It's a great pleasure to be here and also to share the panel with distinguished speakers like Arminio and Maria and yourself. And so these are very topical issues. And as you mentioned at the outside, talking about the pandemic that influenced the debt outlook in the emerging markets, and I would like to actually start with that, if that's okay. And for emerging markets, the COVID-19 pandemic has really pushed the debt levels to new heights. Compared to end of last year, average 2021 debt ratios to GDP are really projected to rise by about 11% in emerging market economies on average, the largest rise in at least 40 years. This is according to our firm Morgan Stanley estimate. So this comes on top of the debt levels that were already historically high. So many countries are expected to really turn to the IMF and the World Bank for help, but among them, smaller emerging markets with a higher solvency risk would be the most at risk, as you can imagine. Specifically for Asia, debt outlook is by and large stable, but we are seeing increasing pressure on the balance sheet as the countries further level up or may be exposed to funding constraints. And this includes the countries like China, Korea, which already have elevated debt to GDP ratios, and also the countries like India and Indonesia, as you know, that these countries are running current account deficits. So going to the question that you asked on the how might the debt stress in emerging market countries impact the global economy and the financial system. The world is actually entering into this pandemic with a very different financial system in a sense, compared to the global financial crisis. So in a sense that is a much better shaped system now and than 2008. And secondly, this virus is inherently an external shock. And what that means is policymakers are erring on the side of providing more support than less. And thirdly, unlike prior crises, emerging market inflation has been very well behaved, and thanks to years of prudent monetary policies. In the event of a debt distress outbreak across emerging markets, these factors offer strong buffer to the global economy and the financial markets, in our view. Across Asia, most of the lending occurs via domestic markets, operating within a localized system. While defaults are likely to increase due to funding stress and create disruptions to the domestic economy, spillover to Asia and the global economy would be limited. The only exception here, obviously, is China, because if the emergence of a widespread debt distress happens, it would spill over to the global economy, given China's large and growing role that it plays nowadays. So far, we have seen few cases of defaults and takeovers at small regional banks. So with policymakers focused on risk control, and therefore we think the risk of a spill over to the global economy right now is actually quite low. So therefore, we are at a critical juncture right now for international coordination to prevent the outbreak of a large-scale debt crisis. This will require support from key stakeholders, including IMF, other multilateral, bilaterals, and the private debt holders. Low-income countries are especially at risk, but all countries and their organizations need to play a role to ensure we as a world emerging from the pandemic stronger and more resilient. So now I want to go to China specifically. And before that, let me talk about Asia as well. So that is, first of all, the Asia financial system is by and large stable with manageable default risks. Unlike during the 1998 financial crisis, most of the lendings actually is now in domestic currency and through the domestic banking system as well. So with most of the Asian currencies also have stronger external positions. So that's something we need to remember when we are talking about how stable the Asia financial system is. And in addition, this pandemic obviously has posed serious challenges for the economies in Asia as well. This drastic drop in international tourism has hurt tourist industry dependent countries like Thailand, for example. And pandemic containment efforts also impeded some of the consumptions in many countries, including Korea, India, and Indonesia. So more importantly, to recognize the systemic risks emerging from having overextended government and corporate debt, which could lead to sovereign or corporate defaults. Government debt across Asia is largely healthy, with most countries having strong external positions, except India, Indonesia, which run current account deficits. So as a result, there could be some policy constraints in these two countries, but it is worth highlighting that their deficits are relatively modest compared to levels in the 1990s. For corporates, the risk of default would be dependent on the availability of funding. While we expect economic pressure to drive credit defaults, bank lending conditions are generally easier, as most of the large Asian banks have significant government stakes. So there is a degree of a home bias, if you will, and these banks would be more supportive of local corporates and rolling over loans. Secondly, I also want to talk about if the economic pressure persists, heightened private sector indebtedness could create funding challenges and lead to higher corporate defaults and challenges to the domestic financial system. But the nature of the Asia financial system means that the risk will be largely localized and domestically dealt with. As in this example, India has been working through stress in the financial system over the past 2 years. As corporates face a period of funding stress after asset quality problems emerged following a period of rapid growth. While disruptive for the Indian economy in 2019, there was a limited spillover to the Asian and the global financial system. The exception is probably for China. And because the emergence of the domestic financial crisis would spill over, as we talked about before, and also the risk of this happening is very low. So China is playing a stabilizing role to the emerging markets. The reason we're saying that is there are two actually aspects of that. First is by keeping its own financial risks in check. And in addition, China is trying by being an additional and growing source of credit to these emerging markets. Financial risks in China comes from multiple fronts. As you just mentioned, Bill, in your introductory remarks, with the financial systems particularly vulnerable to the threats from high-risk shadow banking, widespread loan defaults, and the falling property prices. The financial cleanups was a direct response to the first risk. Since 2016, not only have they cleaned most of the non-standardized credit assets, such as the trust loans, and they improved the transparency of the financial system, they deleveraged and made the financial products in China more recognizable to foreign investors. The cleanup was delayed by the pandemic, but is not derailed. So far, more than 65% of the cleanup has been completed, with the remaining 35% focused on some of the remaining non-standardized credit products and corporates with high leverage. China's NPL situation has been another major concern among foreign investors, with an additional 140 billion, so that's roughly 1 trillion renminbi of NPL to emerge due to COVID. From, excuse me, from what we are seeing, the risks have been quite manageable, as the China banks have been adopting conservative NPL digestion practices in recent years, leaving them room to digest the additional NPL from COVID. Should economic growth remain suppressed at 2%, and that is the estimate for this year, even though this quarter, the third quarter, China GDP has reached over 5%. And we think that for the fourth quarter is going to reach 6.3%. And then we also estimate that next year, China's GDP is going to go as high as 8.9%, because the economy is really picking up on a V-shape kind of a recovery. But the overall, the whole year, it is around 2.3% GDP growth this year. So as such, the pressure on credit quality and asset will exacerbate. So lastly, there is also this falling property prices in China, which is a risk for the property bubble. And real estate represents majority of the Chinese household wealth, as you know, and with most demand driven by investment rather than occupying reasons. So while on the development side, loans are extended based on land as a collateral, but with values untested in the event of a sustained downturn. In the event of property prices start to decline and expectations of further declines continue to build, it will be difficult to convince households to buy assets, and that will decline in value. And the property assets will decline in value, and those holding assets may, the people that are holding assets may rush to sell these assets. So for developers, falling prices could quickly affect the ability to pay off loans and leading to wider default risks. Despite COVID, the sector has remained relatively stable thanks to the quick recovery in property sales and a continued control over pace of developer loan growth. Policymakers are keeping a close tab on the industry, this property industry, and have helped to keep the leverage and the speculative investment behaviors. As Xi Jinping has said, the houses are for living, but not for speculating. Overall, the pandemic has been a real test to China's financial sectors. Given that the strong pace of economic recovery that I just talked about and the results from years of financial cleanup, and China's financial sector so far has remained relatively stable with limited risks. And if I still have time, I'd like to talk a little bit about the external roles that China is going to play through the lending. As we talked about, China is playing increasingly important role in stabilizing the emerging market financial risks, with its lending having increased many folds already in recent years. In a post-COVID world, China is even better positioned to extend financial support to emerging market countries, since it is the first country to emerge from the pandemic, and it is in China's interest to support the Belt and Road loans, most of which have been to emerging markets. Home from China has been largely positive, and we have already witnessed various forms of relief, including direct lending, interest write-off, or debt negotiation. Most of these have been conducted on a case-by-case basis, depending on bilateral relationship, debt level, and the nature of the loan. As more and more sovereigns face financial needs and pressure, we expect China to play an active role, and be that having some form of a compromise or engage in debt standstill with some of the counterparts participating in further multilateral program. Countries like Angola, Pakistan, Kenya, Sri Lanka may be the key beneficiaries of many China's support, considering their high share of Chinese lending. It's roughly about 9 to 16% of the GDP. So taking the long-term view, the pandemic is unlikely to dampen China's support for emerging markets, particularly through the Belt and Road Initiative. And rather, it will be an opportunity actually for China. With its economy back on track and the financial sector stable, this will also be an opportunity for China to increase the strategic value of its outbound investment, enhance its renminbi internationalization process, and also strengthen the foundation for future Belt and Road cooperation.
Okay, well, thank you. You answered the question I was going to ask you about the external lending of China. I would just say that I hope China, and I've been talking with my friends in the People's Bank of China and elsewhere in China, that given the important role of China, not only the world's second largest economy, but as one of the major creditor nations, unlike where they were 10 years ago, that we see them participate more actively in the Paris Club on these renegotiations. And as we all should remember, it was China who pumped in $800 billion worth of funds in the time of the Great Recession to have kept us out of a Great Depression. Most people tend to forget that. So we're looking for China to stay strong, but to also act more as a stakeholder in the sense of restructuring, both in the public and private sector, their external lending. Thank you very much. We don't have a lot of time before questions, Arminio, and I want to go back with one question to ask you. I'm not going to ask our other colleagues to comment because we're running out of time and we need question and answer period here. Give your view of what you see as the role of the private sector in the sense of all of these debt initiatives, restructurings that are invariably going to happen going forward. There's a lot of talk that the private sector doesn't want to participate on the same basis that we're seeing with the public sector, Paris Club, and some of these other initiatives that the G20 has taken. What's your view, since you straddle both sides with your career of the public-private sector?
This is sort of the eternal question, but it comes back in different guises. I think if you go back, we've evolved from a world of bank lending to sovereigns and companies to a world where bond markets are more important. And as I mentioned earlier, domestic currency, local currency bonds also play a very key role. So I see it as follows. Private lending to private companies in whatever format, for now, because we're not dealing with a classic balance of payments exercise, I think will be dealt with typically bilaterally, and given that this, as we've all been saying, is an exogenous shock, I think it makes sense for creditors to engage. Now, in the world of bonds, this is a little more complicated, but we're seeing some of this happen, and I think more will happen. So it's more complicated, I believe, where you have private lending to sovereigns in whatever format. And here the need for private sector participation is clearer and more difficult as usual. And I really don't have any magic solutions. I think over the years you've played a key role in developing principles for dealing with these situations. I'd still follow that protocol, and knowing that it is easy at all. Now, it's interesting if you look, just to finish, the world of domestic currency bonds shows a very marked, pronounced divide between the mature economies and kind of China closer to them, because it's so big and saves so much, where bond yields are extraordinarily low, or deeply negative in real terms, and most middle income countries where you have kind of 6% yields, which are low if you take historical standards, but they're a lot higher than the yields you see in the US, in Germany, in Japan, and so on and so forth. So, it's stable for now. The finances are being dealt with in these countries. And I'd stick to what I said earlier. For the poorer countries where the private sector ended up lending, it's probably not that much to governments. I don't see any way around them kind of getting involved in some way. Now, I think a key feature of the current exercise is how big China is. And if you look at the last few years, China has provided a substantial fraction of the lending, and all I know is what I read in reports and in the papers. China is already dealing with this by stretching maturities and rolling over debts all over the place, ahead of any Paris Club or official sector coordinated effort. I think China has its own strategy. They have a lot of money. They think long term, and I see them just doing their thing. I don't think that's going to change. I think that this is part of the Belt and Road strategy of kind of developing a presence, a strategic presence in the planet. And I don't know. I doubt that they'll jump into the Paris Club anytime soon. They've already gone ahead and did their thing. So everybody else gonna have to figure out some other approach to this. But anyway, my 2 cents.
Okay, thank you, Arminio. I think that we could go on forever on these things, but I know that Emily, we have questions from the audience, so I'd like you to handle that part of of the program, and then if we have any time left at the end, I'll ask our speakers if they have one particular point that they'd like to emphasize if we haven't run out of time. So Emily, you have the floor.
Thank you, Bill, and thank you to all of our panelists for that very comprehensive overview of what's going on around the world and some of the risks. We do have several questions, and I'm going to read them. And I think I'll ask Maria Ramos maybe to respond to this first one. And this question is from Arturo Porzakansky, and he asks, many of the same groups that pushed for the HIPC initiative in the 1990s now advocating for a new HIPC, except this time to be matched by debt forgiveness from the private creditors, which Arminio just discussed a bit. So what are your thoughts on a potential another round of HIPC? Maria, do we have you? It looks like we may have lost Maria. That's unfortunate. Let's start. Maybe Arminio, do you want to take a stab at answering that?
Yeah, sure. Briefly. This is a very old situation. If the private sector lent to governments, I think in the end, and particularly the low-income countries, which is what is now where the action is, I think there will be some involvement. And this question is how, what kind, and this seems like a classic kind of banking situation where you have to work with the debtor and stretch maturities and so on and so forth. It will bring to the table issues other than the current crisis. So how do you treat different situations differently in a fair manner, kind of case by case? So I'm skeptical of one big kind of uniform approach to every single country in the planet. Some were doing well and just got hit by this meteor. Others were not, and I think this is just the nature of the beast. But yes, I mean, we've been talking about this forever. I mean, the private sector lending to sovereigns is not risk-free, and there is an expectation from the official sector that I think is reasonable. If they're going to be the lender in distress players, it's unacceptable that the private sector doesn't participate. So there you have it. So yeah, maybe some, I don't know. Arturo, you probably know more about this than I do. But thanks for the question.
Emily, can you hear me now?
Yes, Maria, we have you.
Yes, Maria, this was directed to you on the possibility
yes, I heard
another
the question
HIPC.
and I was trying to answer it, but I think I thought I was going to be unmuted centrally.
Okay, well, why don't you give your thoughts on the possibility of another HIPC, and maybe very briefly if you thought the first one actually worked.
So I think the first one actually did work. So, and I think I said that in my opening comments. I think the first HIPC did work, and we did actually see a significant amount of progress for almost 2 decades in many of the countries that benefited from the HIPC. We saw countries invest in health and education, and that was also a condition for getting the debt relief. We also saw countries invest in fiscal and monetary management and institutions, and for doing that and building up capability. So we do have evidence that it does work, but I don't know if we've reached the point where it's going to be another HIPC-like structure. I do think, though, and I think from the work we've also done in the G30 and the G30 report, that the call is actually for a rethink around whether the DSSI goes far enough. And I don't know if it's at this stage about capital forgiveness, but certainly there is a potential for us to explore the interest write-offs on some of the debt, particularly for the lowest income countries that have been very deeply affected by COVID, and coming to that realization quite quickly. So I think we are talking certainly about a deeper package of debt relief, which could include, on a case-by-case basis, some of the interest to be forgiven, and I think that will have a much bigger impact than we think. And pretending that we're going to get over this crisis without taking some of these bigger measures is just burying our heads in the sand, and we might actually really condemn a whole generation of young people again to life prospects which are really pretty dire. So I think there is something to think about it. I don't think it's the old HIPC and the HIPC structures. I think we have the world's moved on. Financial markets have moved on as well, and the complexity of the creditors means that it will be very difficult to do another HIPC-like structure.
Thank you very much. Of course, David Malpass, mentioned yesterday that he thought that it was essential that they go for another year, not 6 months. He thinks they're just pushing it off. Yeah. And I think this is something that we're all going to have to deal with. And certainly the private sector has got to play its part, as Arminio says, and take its hits. They always fight it, but at the end of the day, they're going to have to do it. Emily?
Yeah, thank you. I'm going to turn away from debt a little bit for a moment, and let's maybe talk about some of the other financial stability risks that you've brought up today. And Arminio, you mentioned the fiscal policy. The fund also released their financial stability report, where they highlighted corporate debt, market disconnect, excessive risk taking. Are you worried that the focus on debt is causing us to overlook some other sources of financial stability risks?
Well, in the end, I mean, the feature you find in every single financial crisis everywhere on the planet is, one, a lot of debt, and two, a lot of short-term debt, and three, often currency mismatches. That is the nature of the beast. I mean, yes, there are other issues. There may be, for some countries, commodity price issues. I think nowadays, I consider deeper issues to be in play. Massive inequality, risks to democracies all over the world, populism. So yes, But in order for a financial crisis to take place, you got to have the debt. It almost doesn't matter whether the debt was used for investing, financing budget deficits, and so on, because then things change, and one day you wake up with a lot of short-term debt and you got problems. But if I were to add risks, I would, I would also say disaster risks like the pandemic are always a problem. We have one in the making in climate change. It's not like being hit by a small planet, but the impact will probably be greater by the time this thing is over. Why? Because we are not doing enough. So there's another one if you want, but it's not a quick all of a sudden boom, it hits you like the pandemic, but it's probably larger in its overall impact. So anyway, we could talk about risks all night long, but if there's not a lot of debt, you by somehow there's social tension, social pain, all the above, but it's not a financial stability risk. But then you probably would say, okay, who cares? But it's probably another, this would be another panel, talk about, say, political and institutional risks all over the world. I think we should talk about that too, by the way, but it's not the core. If there's no debt, then there's no financial risk.
Yeah, well, there's no doubt that we have built up and are building up a substantial amount of debt, not only on the sovereign side, but very much on the private sector side. And this was an issue way, as you know, about the debt to GDP in China that people were concerned about. But of course, come COVID, they're less concerned about that than they would have been if we didn't have COVID. Do you have any comments on that?
I think the debt situation, as I mentioned, actually caught the government's attention. I think your friends, Governor Zhou Xiaochuan and Yi Gang, these central bank governors, the previous one, the current one, they have been actually focusing on it. But the actions taken by the government 2 to 3 years ago, this supply side reform and also the cleanup of the debt, and including the bankruptcy of some of the banks, while still keeping it open, are very bold moves by the government, and it is not entirely uncontroversial, but at the same time, a surprise to a lot of people that it's actually quite effective, as I mentioned just now, and because of the COVID, it was kind of put on hold or get kind of delayed somewhat, but they have cleaned up about 65% of this bad debt. But these, the debt situation now was largely in China, created by the big banks through the lending to SOEs as well as a lot of infrastructure investments. I think that is the nature of the debt bubble. If we look at the 272% of the GDP, that amount of credit, more than 70% of that is actually used for infrastructure investments. I think the comfort that people are taking from here on this debt level and the fact that goes to infrastructure investment is that different from elsewhere where investments or debt is used to fund consumption. So here is infrastructure, and infrastructure investment means that actually, as long as the government is, the interest rates actually from the government side is actually lower than Japan, and the interest rate is not out of whack, and these assets are viable assets, and these investments there's roads, these speed highways, and these airports built up actually served almost like a form of subsidies to the private sectors and to these SMEs, the small, middle-sized companies. But I think we all agree that there is one issue for China to really take very seriously, and that is how to provide proper funding to the SMEs. Because at the end of the day, it is these SMEs that provided very vibrant, lot of energy and injected into the system. And China, in 2014, China had roughly about 50 million this private sector enterprises. And right now is 100 million. And 60% of the GDP of China, more than that actually, is supported by private sectors. So actually they need more funding. And that is something that's either through the bank lending or through the capital market. So that's something the government, I think, got the joke, and hopefully that we will improve the situation. And right now, as of now, fingers crossed, the capital market in China is pretty active.
Thank you very much. I think China is very fortunate to have one of the great central banks of the world, certainly under Zhou Xiaochuan and now Yi Gang, which I think people tend to underestimate what they are doing actually in China. And I thank you very much for, for answering that question and making that point. Emily, do we have time for one more question?
Why don't we give the speakers a final chance to make any final comments and wrap it up? We have just a few minutes left.
Okay, well, Wei, I'm going to go back to you. Do you have any final comment that you'd like to make on Asia or China that you have not already made?
I think I just want to say that while the current pandemic must be the #1 priority in the near term, I think some of the the colleagues on the panel already mentioned it, that I think thinking about the risk of emerging market debt and the financial stability is equally important. And the China's experience has shown to the world that the financial risks can be kept in check through years of financial cleanup and prudent NPL recognition. And an effective institutional response to the pandemic is also critical. I think even though each country's situation may differ, some countries may face temporary liquidity problems while others may have fundamental solvency concerns, but the mindset should be quite same. So I think embracing the market-friendly solutions and working collaboratively with multilateral organizations and the private sector will offer the best chance of an effective outcome towards the challenges ahead that we have to face.
Very fitting comments of you to end our session here. Arminio, I go to you.
Briefly, the one element I left out in a sort of risk assessment sort of mode that's always there, besides a lot of debt and short-term debt, is hubris. So I think we have to keep a hubris meter on all the time. I look at the forecasts for GDP next year. I see a lot of V's out there, and maybe it'll happen, maybe it won't. People seem to be counting with success as far as the vaccine is concerned. They seem to think they can keep borrowing without limit. I'm kind of bothered by that. So that's those are my final words. Thank you. Good to be with you.
I think your final comments are very sobering in a sense of what goes forward. Also, your point on climate change is actually more serious than what we're going through here, but it's a longer term problem we're going to have to deal with. So the final word is to you, Maria.
Thanks, Bill. I actually want to underscore what Arminio has just said. I think the risks are more to the downside than we sort of starting to believe, and I think we shouldn't discount that. And that this recovery is going to take time, a long time, and it's going to be uneven. And so we need to keep that in mind. And having said that, particularly across this continent, the African continent, I think policymakers need to stay focused on the crisis, because that's important. There are too many lives and too many livelihoods at risk. But they also need to start making some difficult and tough choices to restructure their economies if we are going to recover. Arminio made the point that this is about, this is about debt, and if you're carrying these big mountains of debt, then recovery is always going to be a difficult issue. And there is the risk of underestimating the debt crisis that we're in as well. So we need to keep that in mind, and we have to keep in mind that the climate crisis is here. It's not something that's going to happen in the future. And the final point I'd like to make is that we can only get this done with cooperation and collaboration, and that cooperation has to happen nationally, regionally, and globally. Without that cooperation, we're not going to get any of this done. So, Bill, to you and to my fellow panelists and to everybody else who's taken the time to be with us today, thank you very much.
I'd like to just end way with a Chinese expression that I like to use sometimes, which is 危机, which we're in a terrible crisis, but in every crisis, there's an opportunity to do something. And I think the opportunity here is for governments and the private sector to meet these challenges, to restructure and to implement the structural reforms that we keep putting off, because the next one we get to will be much more difficult if we don't take these opportunities. So thank all of our panel. I think you were all great, and all of our listeners here. I'm just sorry we didn't have more time for questions, and to Morgan Stanley for having financed this.
Thank you, Bill, and thank you to all of our panelists, and thank you, audience, for joining. I hope you can all join us tomorrow for our final International Council session on financing this public health response. So thanks again to our speakers. It was an incredibly rich conversation, and until tomorrow, thanks again.